Thank goodness it's Friday. That's a joke, just a bit of British sarcasm, you know, before you start writing in and saying it's Thursday. I know. Futures are down 2%. Your countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, a soft landing looking a little more elusive.
A big change from the Fed.
The question is if they'll be able to deliver.
Is there a path to a soft landing?
The Fed's forecasts are still remarkably optimistic.
All these numbers they threw out are fantasy land.
Can you thread this needle?
We're raising rates quicker than I thought we would.
It's going to be a very difficult navigating act to try and manage a soft landing.
Things are coming forward a lot quicker.
The balance between soft and hard landing is going to be incredibly difficult to navigate.
The market is having that same realization.
What we have is masses of inflationary pressures right now.
In terms of the Fed,
they are very much going to prioritize inflation over growth.
They're almost doomed to have to be more aggressive.
Joining us now is Morgan Stanley's Vishy, Tirupattur and Kathy Jones at Charles Schwab. Kathy, first to you. Your thoughts on what we heard from Chairman Powell yesterday?
You know, I think it was pretty explicit in the information that we got on the SEP that the Fed is willing and probably resigned to the fact that we'll have a recession if they target headline inflation. So I think Paul tried to sort of dance around that message during the press conference. No Fed chairman wants to stand up and say, yeah, we're headed to a recession because we need to get the demand side down. But that was the message that I took away.
It's the message others took away as well. Wells Fargo said this: we now judge the recession next year is more likely than not. Vishy, do you share that view?
Right. I mean, I would say that the probability of recession has certainly gone up and has been going up for some time. So the risks to a recessionary outcome over the next 12 months is certainly substantial.
Kathy, I'm just going through the forecast, which previously you've called aspirational. I imagine you consider them aspirational now too. Which one is out of sync for you? And let me go through a couple. They've got the unemployment rate next year at 3.9%. They've got PCE back down to 2.6%, and they've got the Fed funds at 3.8%. Which piece of that do you think is aspirational? GDP print, they're expecting to be about 1.7%. Is there a piece of that stands out more than others?
It would be the unemployment rate. I think we're already starting to see some softness in the job market. And remarkably, this is showing up in the beige book and some of the regional Fed write-ups that we've seen. So I'm a little surprised the Fed has that optimistic a forecast, because we are starting to see some loosening in the job market. We're hearing from companies that they have to lay off or certainly not hiring the way that they were. The hiring freezes are taking place. So if I had to put a number on the unemployment rate, it would certainly be higher than that next year.
So equity's down about 2% on the S&P this morning, at least going into the opening bow. Vishy, I just want to know what on earth to do with the bond market. At some point, a 10-year becomes a buy. Close to 350. Is it now?
I would say it's not yet a buy. I mean, given some of the uncertainty there, I don't think we are very far from being a buy. You know, our economists also revised their growth expectations. Our economists' expectations for the growth, 4Q over 4Q for 2022 is below the Fed's 1.4, and we expect the Fed to have a faster and more front-loaded hiking path than what they've laid out yesterday, the dot plots laid out. So I take both of those things into account, and I think that we probably would be close to a flat or potentially slightly inverted yield curve on the 10-year point. So I would say, you know, it would be, we are not that far from getting the 10-year point to be much more interesting to look at.
Kathy, is it interesting to you yet?
Yeah, it is. So we've been suggesting gradually extending duration. We're not going all in. But I think that as the Fed moves to tighten, you'll see that inverted yield curve. And inevitably, with financial conditions tightening, we're going to hit some sort of peak rate in the long end. Now, the problem is that we have still sort of this embedded volatility. So we're going to get some of these spikes. But if I recall back to previous situations that to me this reminds me of, it's the early 1980s when we had, massive rate hikes by the Fed to get inflation and inflation expectations down, and we had very sharp and short back-to-back recessions. And I think that could be what we're looking at, and that those were time periods when bond yields would spike up but then start to come back down.
Kathy, this is a piece of it, and I'm so pleased you brought it up, that I want to spend a bit more time on, not just today, but in the coming weeks too. Vishy, this R word gets thrown around so much, yet no one goes the one step further and talks about the kind of recession we could get, if indeed we get one. Can you talk to me about that, Vishy, that if we do get a downturn, based on what you see in this economy, what kind of downturn would it be? Where's the excess? Where's the leverage? What would it look like?
It's a very good question, John. I think we all need to dig into this into great depth. My expectation is that we do get into a recession. It will be a relatively shallow recession compared to the last two recessions we've had. And the nature in which this recession would come through and the framework at which this comes through is very different than the last two recessions as well. Especially, this could be a recession where we will see a pickup in corporate defaults, but not a spike in corporate defaults. So, in the last two recessions, the financial crisis and the COVID recession that we've had, we saw a pretty substantial spike, dramatic spikes in default rates. Here, I would expect that to be a much more muted because we are entering this at a very different point on the corporate balance sheets, as well as the household balance sheets. So this recession is going to be feel very different, much more. I think as Kathy's reference to the 80s is actually very pertinent. When in those early 80s recessions, we did not see dramatic spikes, or even in the 70s recessions, we didn't see pretty dramatic spikes in corporate defaults that we saw in the more recent recessions.
Vishy, with that in mind, as that develops, are you putting together some kind of playbook you'd think about? Can you share that with us now? What would you be looking to own? What would you be looking to avoid with all of that in mind?
We would be looking to own more higher quality. So we would be looking to own more investment grade over high yield and leverage loans. And within the high yield complex, we'll be looking more towards away from loans, more towards higher quality high yield bonds within the high yield spectrum. And I think we'll also be looking at some of the lower dollar priced bonds, that have recently issued, maybe bonds that were investment grade bonds issued in the last few years that have taken a pretty substantial hit because of duration moves. And since we don't expect dramatic moves in duration from this point onwards, those are good entry points to find investment grade bonds in the $80 price or around there.
I've got to try and work out where the next move is from the Fed before we get into all of this. This happened yesterday with Chairman Powell saying this: I do not expect moves of this size to be common. He went on to say, from the perspective of today, either a 50 basis point or 75 basis point increase seems most likely at our next meeting. Some doubt as to whether we get 75 or 50 at the next one. Barclays came out straight away and said this: we believe that the Fed will go back to a 50 basis point hike in July amid signs that consumption and the US housing market are slowing. Mike McKee, right on cue this morning, that data 38 minutes ago.
Yeah, the housing market's slowing, at least according to housing starts, which were down 14.4%. Steve Stanley, though, of Amherst Pierpont, points out that the total number is about what was expected because these are very volatile data. So it may be a little early, but it does look like things are slowing down. Here's the numbers you're going to want to watch every morning as you get up. What's happening with CPI, and the white line there is what the Fed thinks is going to happen with PCE. But it's that yellow line, it's the idea that the Fed is watching consumer expectations for inflation. If that keeps going up, you can expect the debate about 75 175 to get even more heated. Now, the Fed is going to be raising interest rates. We know because they moved the dot plot up significantly. And at this point, the real question isn't so much where they end this year. They're going to do another 175, they say, is where do they get to next year? How high is the terminal rate? Do they go over 4? 5 members of the Open Market Committee said they need to go over 4% to get inflation down. That's something else to keep an eye on. What are people going to be telling us about that? And then finally, you're talking about the recession. Here's the thing. The National Bureau of Economic Research is the ones who sort out whether it's a recession or not. And if you look at the indicators, and this is kind of a weird chart, I did this only to annoy Tom Keene, who hates a lot of lines.
Don't worry, he's on radio. You carry on.
But basically what it's showing you is mostly stable to up, the indicators that they follow to determine if there is a recession. And so at this point, it doesn't look like we are there. Now, you can project out what you think is going to happen, but that's just what it is, a projection. And as the Fed's found out, and Jay Powell admitted yesterday, projections can be wrong.
Hey, Mike, as we found out, too, I went through the sequence of things of the year so far. Do you remember when Ethan Harris of Bank of America said a hike at every meeting and people pushed back? Consensus. Then you had Andrew Hollenhorst who said 50, 50, 50, 50, and people pushed back. Consensus. And for a moment, was it Jim Bullard in an interview just floated one out there about 75? And I laughed and I pushed back, and here we are, 75 yesterday. Mike, yesterday, I think you asked one of the most important questions at the news conference, and Chairman Powell struggled with it. And I'll boil it down to just one line that you mentioned. Is this Fed going to chase the price of oil?
Yeah, and that's the problem for them is what people are worried about and what people see every day is the price of gasoline, the price of food, things the Fed can't do anything about, and those are still rising. If that continues, then the Fed has a problem because it can raise interest rates all at once and it won't produce another drop of gasoline. So what do? That's Jay Powell's admission to that question was basically not a lot we can do.
They're in trouble, that's for sure. Mike McKee, thank you. And to Kathy Jones and Vishy Tirupattur, to you guys as well, thank you very much. You're going to be sticking with us as we count you all down to the opening bell with equity futures negative and bond yields higher, a whole lot higher. Let's get you some moves ahead of the open. Let's say hello to Abby. Hey, Abby.
Hey, John. Well, that Powell pop from yesterday's meeting, it certainly has faded. We have U.S. futures down sharply, as you were mentioning, down about 2%. Interesting, right around where we were ahead of the Fed meeting. So a lot to do about nothing, but not a lot of actual change so far. But that means that the big tech rally that we saw yesterday after that meeting, it has faded too. Apple, Nvidia, Applied Materials, Tesla. So a wide variety of tech names lower as yields are higher, although again, kind of where they were ahead of the meeting. But that means that valuation and concerns of more expensive everything weighing on tech and weighing on the futures going into the open, John.
Abby, thank you. Coming up, the president, the White House, has a problem at the pump.
He is open to all reasonable uses of federal government's tools to increase output and lower cost at the pump, including emergency authorities like the Defense Production Act.
That conversation up next.
Already, the president has demonstrated his willingness to use that emergency powers to lower costs for families. We're saying that the president has used it before, and he's willing to do that again.
The White House signals it's open to using emergency wartime law to increase gasoline output. This coming as Exxon responds to President Biden's call on big energy with a suggestion of its own that said the following. The U.S. government could enact measures often used in emergencies following hurricanes or other supply disruptions, such as waivers of Jones Act provisions and some fuel specifications to increase supply. Joining us now is AMH down in D.C. Anne-Marie, that letter went on to say and concluded with a really, really important line. Longer term, government can promote investment through clear and consistent policy that supports U.S. resource development, such as regular and predictable lease sales, as well as streamlined regulatory approval and the support for infrastructure, such as pipelines. This is the disconnect right now, isn't it?
Yeah, and it's not just Exxon, Jonathan. Very, very late last night, we got a letter as well from Chevron. I'll bring you a little bit of that. Chevron saying they understand the significant concerns around higher fuel prices currently faced by consumers around the country and the world. We share these concerns and expect the administration's approach to energy policy will start to better reflect the importance of addressing them. Here's the zinger. Quote, unfortunately, what we have seen since January 2021 are policies that send a message that the administration aims to impose obstacles to our industry delivering energy resources the world needs. Clearly, the oil industry has got the letter from the president, and what they're asking back is a bit more clear policy. Do you want this to be an industry that flourishes in America, or do you not? That's really what it comes down to. And when you look at what the president can do in the short term, they're going to need the industry for that help. You have the press secretary talking about the Defense Production Act. What does that actually mean? On the margins, what can the president do? There's not really a whole lot of refineries you can just start overnight. So this would take a lot of capital investment and encouragement from the government.
So what are you focused on, Anne-Marie? You focused on what they can do domestically. They're constrained somewhat. What they can do on the international stage, a visit to, say, Riyadh, catch up with the Crown Prince Mohammed bin Salman. What can actually address some of this, alleviate some of the pain ahead of the midterms, which, let's face it, that's the political one they're focused on.
Right. When they wake up every day, Ron Klain is checking, the AAA gas price the same way I do. And it's average of $5 a gallon right now. So we should break it down to two parts, Jonathan. One is the global oil market, right? Obviously that there's been constraints there coming out of a pandemic. There's a lot more demand that's needed, not enough supply, and then it's exacerbated completely by taking out the super commodity store of Russia. So yes, the president is going to go to the kingdom. We've already seen an olive branch by Saudi Arabia in the last OPEC Plus meeting to boost production. Potentially, there could be more there in Saudi Arabia after the president makes this visit. But Saudi Arabia alone, the UAE, these two countries that have spare capacity, that will not solve $5 a gallon gasoline by itself. The other issue, what the president's letter was addressing, is refining capacity. Spare capacity for that is in China. The United States, it's going to be very hard to try to get more refineries. These require long-term investment. They were struggling before the pandemic hit. Mike Wirth, earlier this month, said to Alex Steele he cannot see another refinery being built in the United States. So this is the problem this administration has. First, you have to get more oil. Second, how are you going to turn it into products? It's a huge struggle, and it will not be fixed before November.
It's a big, big ask. AMH in Washington, thank you. And it could get a whole lot worse. Take a listen to Jeff Curry of Goldman.
Markets move faster, and the fundamental tightness is deeper than what we would have thought 3 or 6 months ago. This is where we should be, but it's a lot deeper than what we would have initially thought. Energy and food right now, as we go into the summer months, is severely skewed to the upside.
Kathy, is this Federal Reserve going to keep on chasing what's happening in this commodity market?
It's a real conundrum because they can't have any influence on the supply side, especially in food and energy, and yet they seem focused on bringing demand down to meet that limited supply. And if it continues to do that, we're going to see a recession, and we're going to see it sooner rather than later. So I hope that policy isn't just focused on gas prices, but I do know that it works its way into inflation and inflation expectations. So they're really caught in a rough spot. I think they'll try to navigate this as best they can. But it seems if the Fed is determined to just focus on headline inflation, then there's nothing left to do but keep raising rates and squash demand. And that's not a good scenario for the economy.
I'd go a step further as well. I think it makes it all even more unpredictable. Vishy, let's just talk about it. You've got energy, which everybody is terrible at forecasting, influencing inflation expectations, which the Fed is determined to respond to. With that in mind, Vishy, how predictable is it when you start to think about what the Fed's going to be doing beyond summer, if so much of it is dependent on what happens in the energy market, because that is what's influencing expectations?
It definitely puts the central bankers, not only the Fed, in a bind. Our expectations here is that the Fed will deliver another 75 basis point hike in the July meeting. We continue to see upward pressure on the core CPI from the data in hand, as well as some of the work that you can get on using the CPI fixings market. And thereafter, our economist, our U.S. economist, Alan Zepter, thinks that 50 basis points through November, in these two subsequent meetings, and final 25 basis points hike in December. This is, I do think that the inflation fighting is at the top of priorities for the Fed, and the playbook we expect that they will continue to follow is front-loading the policy shocks.
Vishy, thank you, sir. Vishy Tirupattur, alongside Kathy Jones and Morgan Stanley and Schwab, respectively. I've just seen something on the Bloomberg that I don't think I've ever seen covering the ECB for a long, long time. Listening to the Italian central bank governor put a level on the Italian-German spread. He's done this in the last 30 minutes or so. So just quickly work the Bloomberg for you. The Italian 10-year versus the German 10-year. That spread right now about 200 basis points. Last year it was inside 100. The peak in the last few weeks, 242. This is what Visco had to say. The Italy-Germany spread should be 150 basis points based on the economy. The fragmentation, the so-called fragmentation, and when they say that, they're talking about Italy and the periphery and what happens in the bond market, impedes monetary policy. And the recent increase in spreads is unjustified. This is the pushback you're starting to see in the bond market. What I've been surprised by is that you've got a central bank governor, in Italy of course, making the case for 150 basis points. So you've got central bankers now telling you where they think the price of the market should be based on the economy. And you've got the Italian central bank governor saying it should be 150 basis points based on the economy. Go figure. We're at 202 basis points right now, 52 basis points north on that spread. But this is the conundrum, the dilemma for this ECB, this central bank at the moment. They're trying to increase interest rates. They're trying to tighten financial conditions, but not too much. That means we get fragmentation in the bond market, which ultimately impairs monetary policy and means they have to back away. The dilemma for them is, how do you achieve both? How do you achieve higher interest rates without sparking fragmentation in the bond market? And therefore, if you have to step in, how do you make sure that you don't ease financial conditions? I just think it's bizarre that we've got an actual central bank governor in Europe right now trying to put a price on the market to try and say that this is what's justified. And I wonder if they're backing themselves into a corner now, because any vehicle they have to come up with ultimately, is that the lid that they're trying to keep on spreads? One to think about. Up next, your morning calls, and later, investors repositioning after a big interest rate hike at the Federal Reserve. Sam Lynton-Brown at BNP coming up. This is Bloomberg. Five minutes away from the opening bell, equities lower by more than 2% on the S&P, and the Nasdaq 100 down by 2.6%. That's the price action. Here are your morning calls. First up, Jefferies downgrading DuPont to hold, turning cautious on chemical stocks amid rising interest rates. Citi upgrading Boeing to a buy, seeing limited downside even if near-term headwinds last longer than anticipated. That stock is lower by about 1.5%. And finally, Morgan Stanley upgrading Dollar General to overweight, favouring defensive stocks as the likelihood of a recession keeps growing. That stock is unchanged. Coming up, BNP Paribas, Sam Lynton-Brown says it's time to buy stocks. That conversation up next, your opening bell just around the corner. "24 seconds away from the opening bell with equities down this morning. Good morning. The S&P 500 looks like this, down by 2.3%. On the Nasdaq 100, down by 2.6%. On the Russell, down by 2.3%. Yesterday giveth, today taketh away. That seems to be the theme this morning. Switching yesterday almost upside down. It's yesterday in reverse. Look at the bond market, it's the same thing. Yields up 15 basis points, 3.43% on a 10-year. In the FX market, euro dollar trying to hold on to 104. Positive now by a couple of tenths of 1%, 104.62. And crude, negative 1%, 114 on WTI. About 15 seconds into this, we're negative 0.6 of 1% on the S&P 500 around the open. Real estate down by 1.9%. Housing starts this morning ugly. Information technology down 2%, consumer staples down 1%. We're down 1.99% now as more stocks start to get open and we get those prices down about 2% on the S&P 500. Should we get you some movers? We can do that with Abby. Hey, Abby.
Hey, John. Well, we do certainly have stocks sagging here on the open. A lot of those heavyweight techs really weighing in a big way. I know Ed will be looking at that more closely, but we have a lot of inflation-linked stocks that are down sharply, too. Kroger, the grocery store company, it is down 3.6%. This as margin pressures way overshadowing a pretty solid sales beat. Not surprisingly, that is a story we're hearing over and over. Gross margins of 21.6%, 40 bips short. Rising costs eat into their profits. Now, ExxonMobil, this is interesting, down 2.5%. A lot of markets are exactly where they were yesterday, ahead of the Fed. But oil is actually lower. That's a positive, perhaps, for the consumer, but for big oil, not so much. So you see those shares lagging and sagging. Ford down 3.9%. This after those weak retail sales a couple days ago, really highlighting the drop in car sales. But also they have shared that they are losing money on their Mustang EV SUV. Some are also saying that Ford and GM are preparing for a recession. And then finally, a possible bright spot here, Twitter, John, a stock that we love to follow. Elon Musk, of course, is speaking to the Twitter staff for the first time. They, of course, have learned that their Disneyland trip in January is canceled for cost cutting. But Elon Musk speaking, traders, investors liking that as a sign that maybe the deal goes through. I would point out, though, John, that spread about $15 between where the stock is now and the price that was offered in mid-April.
It's still pretty wide, isn't it? Abby, thank you. About 2 minutes in, we're down by 2% on the S&P 500. Everything negative. Staples even negative 1.2%. Discretionary down by almost 3%. Off by 2.86%. Looking at information technology down 2.5% on the West Coast in San Francisco, where he resides. Bloomberg's Ed Ludlow. Morning, Ed.
Yeah, good morning, Jonathan. Looking on the MOV function on the Bloomberg, on the NASDAQ 100, you look at Apple, Microsoft, Amazon, Tesla, not just the biggest points drag on that index, but down serious percentage point declines between 3% and 4% in some of those names. I have a sense of deja vu, and I think you were discussing this yesterday on Fed Decides. How many times have we had a Fed meeting where in the session stocks rally, particularly the technology sector, and the following day we see a heavy sell-off because everyone goes to bed, yields rise overnight, exactly like we saw in the last 12 to 24 hours, and technology sector has some pain in the following session. You look at that chart, that is the story right now. But really, reading across the Bloomberg, we've moved from the narrative where higher rates discount the present value of future profits to recession fears, and we go back to what we learned in earnings season. This sell-off in risk assets also, of course, extending to Bitcoin, which I'll give a quick shout out to. We traded kind of sideways over the last few days, but over a longer duration, this is a really big drop. And I was interested to listen to the comments of Scott Maynard of Guggenheim yesterday, John, saying to you that this is not a diversifying play. This is a risk asset, just like everything else. And the declines we saw in Bitcoin should have been a leading indicator for investors of what was to come. Really interesting forward insight from him.
That's something Scott said, that this doesn't bottom the equity market until that does.
Exactly.
Bitcoin. Ed, let's catch up on Twitter in just a moment. I think we've all learned that lesson over the last couple of meetings, just never to define the Federal Reserve meeting by the post-Fed price action, the intraday moves. We talked about that yesterday, even with those massive moves. We need to catch up with Taylor Riggs. Taylor Riggs, that rally evaporated pretty quickly.
It did, John, and you're right. We sort of all learned our lesson. We learned that yesterday at the closing bell, too, right after your show there. And I think what's interesting is, you think about sort of the revisions downward and where we are with some of the strategy targets. The average, we're now down to about a 47, 43 from last month, off almost 3% to the median, as you can see there, at about a 46.50. I don't know if this is the JP Morgan note that just came out that equities are now pricing in 85% chance of a recession, or if this is just the basic higher yields means that we lower the net present value of what equities are worth today. Either way, you're starting to see some of these price targets come down just a little bit. I think what's so interesting, and our producer Pete Diartoris has done a lot of good work on this. If you've been super bullish, you're super bearish, you're sort of holding to your guns, if you will. But it's sort of the guys in the middle. 7 out of 30 respondents in the last month, or about 30%, are cutting their outlooks. You're starting to see some of the guys in the middle, and the squishiness there, bringing down some of those price targets here as we sort of reevaluate where we are. The big question, John, has always been, what is defensive in this market? In the pandemic, it was tech. I think we're slowly learning that maybe the new defensive isn't technology. It's the opposite. This is high growth, minus defensive. And you can see that growth is really the big underperformer now for 7 straight months relative to some of the defensive sector. But what is defensive? Is it dividend stocks? Is it cash, which gives you that optionality? That sort of is the new big question.
Cash, as Tom has been telling us for years, through the
Trash?
whole of the bull market. Cash, apparently, triple leveraged. You know the story, Taylor. Taylor Ricks, thank you. Let's catch up soon. Someone's bullish. I found them. It's Sam Lynton-Brown over at BNP. Says this: we're positive on equities. They already priced too bearish a cyclical outcome. In our view, a hard landing is not predetermined. Sam, I'm pleased to say, joins us right now. Sam, the floor is yours. Give me the bull case right now.
We've had a derating in the S&P that we've seen twice in the past 30 years, each of which has occurred in the midst of a US recession. In Europe, the market already prices in an earnings contraction that we think is only compatible not just with a recession, but with a prolonged recession that feeds through to the labor market that leads to corporate defaults. If we look at Fed pricing, the timing of the first cut once the Fed end the cycle in terms of hikes is quicker than is typically the case. And if we look at the dollar, it trades rich even versus those other cyclical negative points I just pointed to. So our medium-term view is that we're in the zone of peak hawkishness. A hard landing is not a predetermined fact, and therefore that on a medium-term basis, this isn't a bad level to be positioning low-risk assets.
Sam, what kind of landing are you
term,
anticipating? Just to jump in, can you tell me what kind of landing you are anticipating?
If you ask that question to our chief global economist, he'd say it's a soft-ish landing. Now, it's not a soft landing, was clearly not anywhere near a Goldilocks-style scenario, but it's a landing where we think a global recession can be avoided, which we'd argue is different to what the market is now discounting. Now, that's the medium-term view, but I think clearly one needs to acknowledge what's happened in the past few sessions. And the market's very much perceiving that what we're seeing here is a coordinated, accelerated pricing in of central bank tightening cycles. Forward guidance is out of the window. It's all about data dependence. And that really does inject an additional uncertainty. And so it means that in the very near term, independent of your medium-term view, one needs to be, if you like, quite humble and nimble and lightly positioned.
Sam, before people buy this market and get more bullish, are you comfortable with earnings revisions? Do you think we've seen sufficient downgrades on both the analyst side, but also from corporations to come out and say, this is what we think is going to happen, we're cutting our outlook? Have we seen enough of that?
It's a question of what the market is pricing relative to bottom-up analyst expectations. And that's where you have an absolutely huge discrepancy. Europe is a good example, where after the Q1 earnings seasons, forward-looking expectations in Europe were revised up over the same period in which Euro stocks went down 10%. So the level of earnings growth that current prices reflect, here you have to make some assumptions on normal levels of equity risk premium, are such that the market already is pricing, especially in Europe, a very significant earnings recession. So I'd argue it's more a question of if the market has already discounted a very different backdrop to what the analysts are expecting, and our answer to that would be yes.
So this raises an important question. If you are constructive, the parts of the market you want to be buying, Sam, and holding over the medium term, where is it? Where are you comfortable stepping into? And more importantly, I think also, where would you want to avoid?
In this type of environment, like I said, one has to do it in quite a humble and a nimble way. So in US cyclicals, we like positioning through 1x2 call spreads. The reason this is attractive is if you're wrong, you don't lose a lot. And it sells what we'd refer to as the right tail, the big upside potential in US equities that we think is unlikely, because even if the market does perform well in line with our expectations, the Fed reaction function is such that we've gone from being long a Fed put to being short a Fed call, i.e. the right-hand side tail, the big upside of risky asset returns is capped, and therefore we like 1x2s there. In Europe, I'd say financials is an attractive place to be positioned. We've seen, and perhaps we can talk more about it, this rhetoric from the ECB that's shifting the dynamic there on spreads. And given how cheap financials trade relative to the level of yield, that's an area we also think can recover. In FX, the Australian dollar, we think, is poised to outperform on a broader recovery in risk sentiment. And I'd also throw in somewhat counter consensus that the euro could be basing around these levels.
Oh, Sam, some of that is out of consensus. We've got to talk about the banks. You're a brave man. Are you ready to step into the European banks, given what's been happening with Italy, and given that we still the only thing we have from the ECB is a plan for a plan, and not actually a plan that they can engineer and use anytime soon.
A plan for a plan. I think you put it well. But the broader question I'd say is, look, the market needs to be convinced that the ECB has spreads under control. And I think there's been a pretty big development over the past 48 hours in terms of calling that emergency meeting, making it very clear that it's not just that a backstop is being discussed, it's that it's effectively already been agreed and that an announcement could be imminent. And we've even seen in the past 30 minutes the officials out of Italy going so far to put a specific level where they think BTP spreads should be traded. So our view heading into this year was bearish EGB spreads. We'd advocated to be positioning for BTPs to widen. We had a 230 basis point target on that trade, and we took it off as it hit that level. And perhaps the path for spreads could be a little bit wider from here because the market has retraced so sharply. But I think the broader question is, will the ECB allow the market to price fragmentation risk? We think the answer to that is no. It doesn't mean they'll immediately be successful in their aim to prevent that, but ultimately we expect them to be. And if they are, then these types of levels in, I'd argue, both euro-dollar, but also in Eurozone financials are sufficiently cheap that risk-reward's attractive to be long.
Sam Lynton-Brown, that's some brave stuff. You're going to stick with us. We'll carry on talking about it. We're going to do a segment on the ECB and we can dive a little deeper into this stuff. Sam's going to stay with us. I want to touch on what's happening with the Tesla CEO, Elon Musk, as well, holding this meeting with Twitter employees. I want to cross back over to Ed. Ed, just get us up to speed on what we can expect today.
Yeah, so Elon Musk is going to do a virtual all-hands with Twitter staff. I'd note this is pretty normal, right, in a deal scenario. This is not a normal deal scenario, but when deals are normal, then the acquirer will often address staff as the deal proceeds. Twitter staff are being invited to submit questions, according to sources, and they basically have three top questions, John. Is this deal going to happen? Fair enough. They also want to know a little bit about Musk's political stance, which is interesting. You know, many Twitter staff are left-leaning, San Francisco liberals. They don't agree with Musk's politics. And then the third is kind of things that impact them, right? Compensation, Musk's work-from-home policy. Twitter has an indefinite work-from-home policy as it stands. Lots of these staff want to know, will this change?
Ed, thank you. Ed Ludlow on the West Coast on top of the Twitter story. He'll stay on top of that through the day on Bloomberg TV and Bloomberg Radio. Yesterday, we had a 75 basis point move from the Fed. This morning, we had a 25 basis point move from the Bank of England and the first rate hike from the Swiss National Bank in 15 years.
If you look at our inflation forecast, it clearly shows that inflation is now higher.
A 50 basis point hike from him, and that conversation is just around the corner.
We believe it was necessary to increase rates today. If you look at our inflation forecast, it clearly shows that inflation is now higher. There's also a certain risk of second-round effects, a certain risk that inflation does not come back below 2% by itself. And so we came to the conclusion that it's now the right time to make a certain adjustment of our monetary policy and to tighten.
That was the Swiss National Bank. They went 50 basis points. The Bank of England followed. They went 25, and the committee wrote in a statement the following. The committee will be particularly alert to indications of more persistent inflationary pressures and will, if necessary, act forcefully in response. So what have we had? 75 basis points from the Fed, 50 from the S&P, 25 from the Bank of England, and 0 from the ECB. Maria Tadeo joins us now from Brussels. Maria, they've got a plan to make a plan. And we got some reporting and some comments from the Italian central bank governor too.
Look, I knew you were going to ask me about the Italian central bank. Ignazio Visco, of course, he was asked about this fragmentation in the market, about the risks potentially to the Italian economy. And he was very clear. You know, he was asked what is fair value, and he said 150 basis points. That is the fair value of an Italian 10-year BTP and a German bond. Everything else that you see, including, of course, the big blow up that we saw at the start of the week, 250 basis points, is extra fragmentation. And that means her monetary policy is not only not not working, but it's also penalizing Italy in a way that he would consider is unfair. Now, a lot of this, Jonathan, you can have many opinions, but he's not the only one that would tell you this in Italy. The Italian government, many Italian officials, they all argue the market looks at Italy like the basket case that it was potentially maybe 10 years ago, but they don't notice and they don't price in that this is Mario Draghi, that this is a very different leadership, that there is funding coming from the European Union, and that, of course, the reforms will begin to kick off. But the reality is, where is the growth in Italy? Ultimately, that is a big challenge for the country. All of this, I have to say, to really increases the stakes going into the meeting in July. And Jonathan, yesterday you asked me, when are we going to get this tool? Well, what we hear now is that the European Central Bank really wants to get the anti-fragmentation tool ready to go by the July meeting. And the thinking here is that on the one hand, you take rates higher, that is very well calibrated, is 25 basis points. And on the other one, you announce the anti-fragmentation tool and hope that that will create a sense of calmness in the market and not create a lot of jitters as you hike. That is a hope of the central bank. Whether it works, well, we'll have to wait and see.
Maria, thank you. Maria Tadeo. We're lucky to have Sam Lynton-Brown and BNP Paribas with us because he's got a very different view on Europe. I think almost out of consensus. In fact, I would say out of consensus. Constructive on European equities and the banks in particular. Sam, let's talk about this. The most effective bond market backstop I've ever seen, I think most of us have ever seen, was President Draghi's whatever it takes, and ultimately a plan that never even had to be used. He didn't have to buy a single bond for it to work. This time around, with inflation as high as it is and an ECB hiking rates, not cutting rates, I do wonder what needs to be done here. For you to be constructive on the European banks, have you got a really strong idea that you have confidence in of what this ECB is about to do?
It's interesting you mention inflation as a channel here in the way the view's formed, because I think it's actually a very important and somewhat nuanced point with respect to the debt sustainability concerns that the market's trying to trade in Italy. Higher inflation, to the extent that it's going to lead to better nominal growth in Italy, which it's highly likely to, will actually make the primary surplus required for debt sustainability metrics to look reasonable, actually much more attainable. So from that channel alone, it's actually somewhat counter to what people tend to think, a positive factor for Italy. And I very much agree with the comments from your colleague that the market's trading this with a different perception of the political backdrop to what we've got today with Mr. Draghi in charge. In terms of the ECB, what we're expecting is that the backstop will be announced imminently, that once that backstop's announced, the market probably will assume that a July rate hike is likely to come with greater certainty of 50 bits rather than 25. And therefore, you'll have quite a powerfully bullish combination for the euro, where you'll have core yields repricing higher still, but that being accompanied by stable spreads. And that isn't what we've had so far. And that combination of factors, we think, can support euro-dollar from these very depressed levels, which it currently trades at.
Sam, that's a centrally planned market, isn't it? Is that essentially what you're expecting the ECB to engineer here?
Some thought that that was effectively what was happening with Next Generation EU in 2020 and in 2021. And I think the market's expectations on that can flip very quickly. They'll begin to buy in again to this narrative that debt in the Eurozone to some extent is mutualized, and that the ECB simply cannot allow the transmission of monetary policy to be impaired by the market trying to trade fragmentation risk. And ultimately, like people often say, don't fight the Fed, we'd say on this one should not be fighting the ECB. Now, that doesn't mean that spreads need to tighten materially from current levels. It's more the pace of the move and the disorderly impact that's been having on the market that needs to stop. So our target for Bund BTP spreads for the end of this year is wider than current levels. We think they go to 260 basis points. But provided that's a move that happens in a relatively orderly fashion, we think it's a move that's insufficient to hurt European risk assets and the currency.
Well, they're getting hammered right now. Sam Lynton-Brown of BNP. Sam, it's great to catch up and get your perspective on things. It's a brave call, and if he's right, I think we should all give him a round of applause. But right now, it's a difficult call. The DAX is down by more than 3%. The FTSE 100 is down by 3%. The Nasdaq's down by 3%. The S&P 500 is down by 2.74%. That's the equity picture. I'll give you the bond market story. Yields were down yesterday. They're higher today by 9 basis points. The housing data was dreadful. Your 10-year yield's up by 14 or 15 basis points in the US to 343. Coming up, the market moving events you need to be watching. Your trading diary is up next. Last year on the S&P 500, we were up almost 27%. It's all gone. It's all gone. We're negative by 2.7% now on the S&P 500, wiping out last year's gains. On the Nasdaq 100, we're down 3%. That's the equity story. Bond market picture looks like this. Yields are still climbing, still breaking out on 10s. Your 10-year close to 350 earlier, 342.34, up 14 basis points. On a 2-year, up 7 basis points to about 326.72, even with some weak data a little bit earlier this morning. That's the price action. Here's your trading diary. Another Bank of Japan rate decision coming up on Friday. That's going to be interesting. Plus, we'll hear from the Fed Chair, Jay Powell, too. More Fed speak from Governor Waller on Saturday. Next week, US markets closed on Monday in observance of Juneteenth. And finally, a host of Fed speak throughout the week. Mester, Barkin, Powell, Evans and Harker all over again. Wow, what a couple of days we've still got to come through today and into tomorrow. This was the Countdown to the Open. Thank you for choosing Bloomberg TV. This is Bloomberg.